January 20 this day because we have a new president, but congratulations to Joe Biden. So we got a lot to talk about today. We're all working remotely. And so with me today is Bill Davis, Beth Foley, Matt Arenz, and Cliff Hawkins. And Marla is running the controls for us in the background. If you do have questions, you can submit those via your question and answer button. So please submit them as well. And to get us started, we're going to get into this in a little bit. But what I'd like to do is I'd like you to, the box, what you think the top 5 stocks were of 2020. So think about it. You probably have heard, certainly have heard the names many times over the last, at least last year. And so we're interested on what do you think the top 5 stocks were in the market for 2020. So let's get to our agenda. And we want to move through this. So we're going to talk about the VIX. Where is it at? And we've talked about this before on a lot of our calls, but why does it matter? We're going to talk about the S&P 500 and what really led the S&P. I think that many people would have not thought that we would finish where we were in the market at the end of the year. Certainly back in March of last year, wouldn't have thought that. Home country bias. We're going to talk about that and kind of how we see things going forward. We're going to talk about some COVID relief, the national debt and taxes, and then talk about our takeaway as being cautiously optimistic. So Beth, why don't we throw it over to you and let's pull up this chart here and talk about the VIX and what we've seen over the last 6 months and why does it matter to us as an investor?
Well, I think in general, when you casually talk about the VIX, you're talking about consumer sentiment. How are investors feeling about the markets and the economy? And if we recall from live feeds and conversations that we've had over the past 9 months, if the VIX is moving upward, that is a decrease in consumer sentiment. If people are feeling more uncertain, as the VIX gets lower, that signals more optimism or sentiment toward optimism in the market. So looking back here at August, you can see that November we had a spike, we had uncertainty. Maybe that was around the concerns around the election. We had some pullback in the tech stocks at that point in time. But since that spike in the first couple of weeks in November have coming back down. Now, the VIX, this chart shows the VIX ending at about 22. Today it's at 21, maybe feeling good about the inauguration and, fresh start, who knows, but maybe it's just patriotism. VIX is down today, which is a positive thing. If we were to scroll this graph back to last March or February, the VIX was really floating at about a 12, spiked to about a 36, and has been working its way down. So when I look at this graph, what I'm seeing is consumers are feeling better. Investors are feeling better, whether we're looking through what's going on in the markets, vaccines, another stimulus package. But right now the VIX is signaling to us that there's a sense of positivity going on. So that's how I would interpret the VIX graph today.
Yep. Anyone else have any comments on kind of volatility and what we've seen over the last 6 months?
Well, I think, after we had the run up in November. And so what do we have? I think we had a record stock market return in November for the history of the stock market, which, I think surprised a lot of people in that it was the election month. And so since that time, I guess my biggest concern is I haven't seen a new floor being established. And so it's kind of just been creeping a little bit higher and higher, hitting a lot of new highs since that November time period. So I would like to see I'd like to see a new floor established because the previous floor was 4,000 points down from where we're at on the Dow.
Yeah, that's a good point, Bill. Any other comments from the panel? Okay, let's go ahead and move on to the next thing. And let's talk about historical returns. So certainly it ended up, Matt, being a pretty good year, didn't it?
It did. I think probably surprised many people with a V-shaped recovery that actually occurred. I would argue that most people probably didn't expect for that to happen, but quite honestly, it did. And I think a lot of that is attributed to not fighting the Fed, them cutting rates, just ongoing stimulus throughout the year. And so those types of things, and probably at the end of the year, just to push with positivity surrounding vaccinations and those types of things have left people feeling a little bit comfortable. So yeah, it did turn out to be a good year, and obviously the fixed income world looked like it turned out to be much better than initially anticipated due to the fact that the inverse relationship between interest rates and prices. So as the Fed kept cutting rates, bond prices just kept going up, which pumped out returns much greater than we initially would have expected.
And along with that, Cliff, we were talking earlier about typically that first year, once what a Democratic president comes into office and what the markets, at least historically, have done.
Yeah, so since 1932, historically, the first year of a Democratic president's term, the market is at 19.4. So, I think that should give us a little positivity in, with the volatility that we may have, just with still some unknowns out there. Historically, almost 100 years is telling us that we shouldn't have, extreme fears. There should be some growth there. And also, we had talked about this previously, but a Democratic-run presidency averages about 10.6 over their term as well. So I think that allows us a little comfort to know that even with volatility, we're still going to be able to see some growth and some gains.
We talked about this last quarter, and BlackRock had done some research that we had tapped into, and we didn't get one of the things that we were looking for, because the best historical combination is a split Congress with a Democrat in the White House, and historically those generated, it was the fewest combination, but the best returns over time. So we didn't end up with the split Congress, barely by a slim margin. So we'll see where that takes us. If history, we're looking at this one graph and saying, okay, history doesn't repeat itself very often. We'll see if history will repeat itself, and we'll get that strong year this year. I've been talking to some clients who feel really strongly about 2022 because of the impact of the vaccine will have as more and more people get the vaccine through the course of this year, that 2022 could, in their opinion, feel like a real recovery year for us.
Yeah. Kind of that bounce back that they've talked about. So we had a question around what we think that what's going to be the best investment this year. So who wants to take that, right? That's kind of a loaded question, but we have some biases maybe towards one asset class over another.
Well, I would say that the best investment is going to be a diversified portfolio, Eric. And I know that was kind of a smart aleck response, but in fact, I believe that to be true. And on this, while we're still on this graphic, I'd like to point out that the expectation would be that we're not going to do 18% this year in the equity markets, and we're probably not going to do 7.5% in the fixed income market. But we do believe that a diversified portfolio is going to give us positive returns that are going to give us a reason to have money exposed to risk assets. And so whatever a person's risk profile is, we think that we can hit the targets of what that portfolio should generate this year. and probably going to, hit some lows before we get to the next new highs. But somebody on the panel commented about vaccines, and I think as that program becomes more robust and we are able to get the vaccine to more people, I think we'll have a lot more consumer confidence. And with GDP, 70% of GDP being driven by retail and consumer spending, we need people to get back out there, and the only way they're going to do it is if they get vaccinated, I think.
Right. Great. Yeah, some good points. All right, let's move on to the next slide. And so as we continue to talk about this really lays out volatility, Matt, and how many days, right? Do the plus or minus. And so if you want to just kind of go through this for those watching, and what they should think about, or what should they take from this.
Yeah, it just shows extreme volatility in the market, plus or minus 2% in the S&P on any given day throughout the year. And last year, obviously, you can see was pretty high at 44, but only 6 days of that extreme volatility after the second half of the year. So again, some kind of surprising stuff, but I think at the same time, it probably just people calm down a little bit. You saw extreme volatility on the down, you saw extreme volatility on a quick recovery, and then things kind of settled in as people became, I think, just maybe a little bit more comfortable, a little bit more aware of what exactly was going on with the virus. You started getting some answers. And I think, as Congress began to pass some stimulus along the way, that alleviated a lot of other concerns that people had, around evictions and unemployment benefits, those types of things. So it just calmed the storm a little bit. So yeah, I mean, nothing too crazy. The second half of the year, pretty much an upward trend, which again, I think most people were probably surprised by it, but it's where we're at.
Yeah. And when you look back, go ahead, Beth.
I would say I agree, Matt, that, we had a learning curve. We were, in March, we knew something about, it was like, shut it down, everybody stay at home. And we learned more and more and more about the disease itself and its spread. And then when we got to June, July-ish, as parts of the economy started opening up again, indoor dining, depending upon where you lived, other sorts of things, that it just, some of that sitting on the edge of panic kind of calmed down. And I think that's reflected in those fewer high volatility trading days. We just learned more, and we learned how to deal with it. And I think that'll continue. We're going to learn more and how to deal with it as every day goes by.
And, I think the other thing is, you look at 2012 there, right? All the way through to, 2018, there was some pretty minimalized big swings. And we kind of got used to that. And even that 20, in 18, and then it went back down to 19. So, we got used to, over the last few years, on not having a lot of large swings in the market. And the other thing I think about with this, and, kind of where we're at in performance, Bill, is, that just speaks for, don't let emotion carry your investment strategy, right? Because if someone made the decision to get out on March 20th or 21st or 22nd or 23rd, unfortunately, that's money that you'll never get back.
Well, yeah, and it's unfortunate that emotions drive decisions many times, and there was 44 opportunities for somebody to become fearful of a volatile market, and they're not, and people weren't used to that. And when you only had 7 in 2019, again 0 in 2017, and sometimes you get wrapped up in the emotions. And I'll point out that, there is still significant money on the sidelines in the trillions of dollars that left the market on March 20th. So there was a large amount of people that, in the pandemic sell-off, I think that bottomed out around March 20th, that have not come back yet. And they haven't parked the money in bonds. They're just sitting in money markets. And so I think that momentum trade is kind of what's taken this market to where it's at. That people are kind of chasing in, thinking, hey, I'm missing the market. I got to get some money in. And I think that if you're that kind of person, then I think you'll be rewarded with being a little bit patient, because I think we'll have a pullback of probably couple thousand points on the Dow.
Yes, yeah, and I would say one more thing to your point there, Bill. I mean, that exactly is, I believe, what's going on, right? So you have low trading volume the second half of the year because there's still a ton of money parked in cash, and so low trading volume and the market that goes up suggests that nobody's really believing the market's going up. Like the psychology around it would suggest that, yeah, most investors are relatively indifferent on what should happen. So it'll slowly trickle up because they'll say, well, if you want to buy my shares, you're gonna have to pay a premium for it. And so we just kept seeing this momentum of stocks going up on lower volume. And I think for a lot of people, they were saying, well, I mean, things are recovering. I might as well just let it ride. And so those people who kind of bought in, in the April and May, just thought, well, momentum's carrying me. I'll just let it continue to go. And they've been rewarded for it as they bought in those low price points. So I think that's kind of what we saw the second half of the year as well.
I think that when we see those high volatility trading days too, for, whether it's somebody who's been sitting on the sidelines or maybe somebody that just keeps a little cash on the side for some future investing, that those days are opportunistic days as well, to buy in and, maybe following a fund or an ETF, or, that there's some opportunity to buy in when the market comes down, that can be a positive. It doesn't just have to be a negative with regard to losing value. It could be a positive for a buying signal too.
Yeah, great. All right, well, let's move on and just talk next about continuing to talk about the markets and so forth. So the largest stocks, this is an interesting one. So we had some guesses. Microsoft, certainly, Apple, Tesla is another one. Bill, this kind of is, it was a good year, but it was really a few stocks that were real drivers.
Yeah, I mean, think of this, 400 companies only did 9.3% last year, when you had 5 that did over 53%. And that impacted us a lot more in the early part of the recovery coming out of the COVID. And we got that rotation that began in November. So I mentioned that we had a record November, and that was primarily because the other 400 or the other 450 companies finally participated in the rally. And it took that long for that rotation to take place. And so that's kind of continued with this momentum coming into those additional areas. And then those Amazons and the COVID trade, the stay-at-home trade, those really leveled off since November and haven't had much action at all since.
Yeah, without a doubt. I mean, it was all growth stocks that performed, right? So the index-based investing is exceptionally misleading when you look at a chart like this. So if you were to break down a value versus growth, your value last year, the index performed around 2.5%, 3%. Your growth trades performed closer to 40. And so, depending on what side of the equation you were on, if you were a value play or growth play, and value has been rewarded year over year because of things like consistent high paying dividends. So your McDonald's and your AT&T's and your Procter and Gamble's, T-Mobile's, utilities, energy, financials just were hammered last year. And your technology, telecommunications, those companies just drastically outperformed. And so again, it just depends on what side of the equation you were on to actually experience or participate in the actual market growth. So again, a little bit misleading, and this obviously shows it, right? Your FANG stocks, your Facebook, Apple, Netflix, Google, Microsoft, just crazy years. And then now you throw somebody in like a Tesla, whose stock just for some reason continues to go up into the mix, and it just it creates again some additional just long-term concerns when you start looking at overvaluation of indexes and stocks within that index.
Yeah, thanks, Matt. And that gives us an opportunity, Matt. I know we recently, and if the clients out there will see a couple adjustments in the portfolios. And so if you could just take a couple minutes and talk about a couple of the decisions we made in changing in some of the portfolios.
Yeah, I think so. So we just changed really two areas, which would just be the large cap space and the international space, which are pretty core bulk holdings. And we obviously had a tilt probably more towards that value play for the dividend, more conservative type growth consistency in portfolios. And unfortunately, just were not rewarded last year for that. And so the move was really to just go a little bit more balanced approach, and take away the value tilt. And then additionally in the international space was to add just a little bit more total market of the international index, which is going to add some things like emerging markets and some small caps, which we believe in the international space this year and going forward will be rewarded for that.
Great. Good. All right. So let's move on and talk about as we move on, what are our key points? So Beth, you mentioned where the VIX is at. I mean, we just talked about that. It's a measurement of volatility. It's one of the things that we follow as we're taking a look at this going forward.
Yeah, I think keeping an eye on the VIX it's not anything that I think we have to like study day to day, but just to know where the trend is at. I think that it helps us understand where our clients might be thinking too, kind of relating it back to the general sense of things. Now the VIX is, the market is always forward looking, which kind of explains maybe why the markets were going up so much on January 6th. But with the VIX goes down when traders are buying more call options. So, a call is the ability to buy a stock at a certain price, a stated price. So you want to buy something and hold it and look for it to go up. The VIX goes up when there are more put options being purchased. So a put is the ability, regardless of what the market is doing, for you to sell a stock at a previously stated price if you want to get out when the market is going down. So, that kind of reflects where institutional markets are going, what general public is thinking. So watching the VIX just kind of tells us where sentiment is going moving forward. So I think that's why it's something that we keep pulling back to in these conversations every quarter.
Well, and I would add to that the VIX number has moved from top to bottom 28% just in the first 20 days of the year. So that's still pretty volatile.
Yeah.
Even though the market's kind of just stayed high, I think there's quite a group of people out there that have put a lot of put positions out there that it's some pretty big money, some pretty big bets that we're going to have a pullback. And so I would kind of believe that some of those people understand the what's going to be coming here in the next couple of weeks.
Yeah. Yeah, and then Cliff, we talked about it. The S&P 500, right? It was led by those top, Matt mentioned those growth stocks that just shot up, and so
I mean, so
probably won't happen every year. May never happen again the way it happened this time.
Yeah, the mega cap stocks led, right? The COVID stocks, and I'd be hard pressed to believe that we're going to see something like this. Knock on wood, barring another pandemic. It's just we haven't had it. We haven't seen it before. Growth hasn't performed like this before. And I just don't believe it'll perform like this going forward. Another thing too, Matt mentioned is, a lot of those growth stocks are really overvalued as well. So that's something people have to take into consideration when you're thinking about purchasing those stocks.
Yeah, that's a good point. Home country bias. So Beth, I know you participated in some, sessions to kind of keep us updated, and they talked about this, right? Having a home country bias. Why don't you?
We talked about this and specifically related to the U.S. that if I remember my numbers correctly, that in a typical diversified portfolio, U.S. stocks in a diversified portfolio generally make up about 56% of a typical portfolio. And that number is now at 70, on average, 75% of the portfolio. And I just had a client who sent a note to me today with this particular issue, and it may be because of the growth in those S&P 500 stocks, that big, the big uptick even in November and December, that portfolios have become very overweighted in the US markets. And the recommendation isn't to become underweighted in the US markets, but maybe to use some of that to diversify a little bit. People, struggling with the returns coming out of Europe and emerging markets and so forth. But whether it's through growth, whether it's through comfort level, that a lot of portfolios have become overweighted US markets, and it might be time to diversify that a little bit. So what it's talking about is home country bias, is just this growth and gravitating toward names that are familiar and comfortable, or even just providing a whole lot of growth like Amazon and Microsoft and so forth. So I think when I look at home country bias, that, to something Bill said earlier, that a diversified portfolio may be our best bet in the coming 12 to 18 months or so forth.
Good. Thanks, Beth. And so Matt, we COVID relief, getting ready to write a big check.
Yeah. Just keep having to, bail stuff out. I think the jobs report tomorrow is another 935,000 unemployments. New unemployment claims is what's going to be expected. So, I think a lot of the increased unemployment that we've seen over the last couple months is because stimulus ran out. The PPP loans expired and people began to get laid off, and now we'll probably see the extension of that and extension of unemployment benefits. But the national debt just keeps going up, and potentially we'll see some tax law changes that will help try to offset some of those costs with capital gains and some estate tax things. Those high income earners is what the expectation is. Anybody over 400,000 or more are going to foot some of that bill. So we'll see how all of it shakes out. But I think there's always opportunity in portfolios and strategies when it comes to investing in taxes that we're just recommending that people begin to explore for their personal situation. Things like Roth conversions or tax harvesting on losses, those types of things, gifting strategies, because this COVID has cost a lot of money personally for people and for the government, and it's going to have to get funded somehow.
Yeah, Bill, and I know you commented on the national debt, right? It continues to. We haven't seen that ticker lately, that on-running thing that they have on TV, but boy, it continues to go up, doesn't it?
It's got a lot of zeros on it, I can tell you that. And so cautiously optimistic, that's my word. And I think we continue to ride this momentum freight train for a while. Expect a drawdown. That would just be normal. We haven't had one, we haven't tested the lows all the way back to the beginning of November. So that just makes me a little nervous, but we're going to ride the momentum freight train here. We're going to rely on fiscal monies coming into the bond market again, continuing, and we're going to see monetary policy coming as well. So we're going to keep writing checks as a government, and we're going to keep kicking the can down the road as it relates to doing that. But right now we can afford it at low interest rates. But as Matt's talked about in this call in the past, when interest rates start to go up, we are going to have to start looking closely at our fixed income portfolios, because when interest rates go up, bond values go down. So, but I am cautiously optimistic that we're going to have a solid year. I don't think it'll be the kind of year that we had last year, but I certainly didn't predict that we would finish as strong as we did.
I think another thing to point is, it's good to see even, some blue states are beginning to say, hey, we need to stay open. Their governors and their mayors are coming around to say, hey, it's time to open up as this vaccination gets released. And, in a traditional world, the U.S. economy being 70%, to Bill's point earlier, consumer driven, about 2/3 of that is on consumer services, and about 1/3 of that is on goods. And last year we saw 2/3 of that on consumer goods and only 1/3 on consumer services. And so as the economy reopens, what we would expect to see is that to normalize again, which means all of the other companies that didn't perform well last year, which are technically consumer driven on service sides, your utilities, your financials, your energy, those types of things. We would expect to see with lower PEs there a lot more rebound and some of maybe the overpriced technology stocks. And not all of them are just tech based, but a lot of the overpriced consumer goods. I mean, again, you look at like a Netflix, for example, today was up another 15%. Like, how high can those go? I don't know. But what I do know is eventually, as people begin to get out in the world and they turn off their electronics and some of that stuff, we'll probably see some of that shift come back. Some of those prices come down. We'll see some earnings come up on the other side in the value-based investing, which will help normalize some things, especially if we do see a pullback in some of those aggressive growth stocks. We're going to need the value stocks to really counterweight that for good performance in the S&P for 2021.
Yeah, that's good. So any other
Yeah.
kind of final comments on our key points here?
I was just going to chime in and say that I'm kind of in Bill's camp. I'm cautiously optimistic as well. I think there's bound to be some sort of a pullback, to Bill's 5 to 10% more than likely. But then I feel like there's going to be a rebound after that. If we can get the COVID relief, which is literally a shot in the arm, literally in the arm, with 100 people, 100 million people, in the first 100 days, I think the economy will start to open up. People will get out. People will spend more. And I think that will allow the market to continue to grow, even if there was a previous pullback. So I'm, again, with Bill, cautiously optimistic.
Thanks, Cliff. Yeah, and for all of you, as we continue on throughout the year and we start seeing some potential tax policy changes and how it may affect, all of us, we certainly will be putting out workshops and other educational pieces to kind of help people understand it and how really it affects you personally, and of course working with any one of us in your meetings where we'll be working through those issues as well. A couple things I wanted to just thank you for everything from last year. So and pull up this slide. We did some several kind of nonprofit work last year in collaboration with all of you clients, and we want to thank you for that. We collected during December almost 600 pounds of food for the food bank that provided over 450 meals. And then the other thing we did is, we also provided a matching program to some nonprofits. And so we were able to combine thousands of dollars of client contributions as well as Hilltop Wealth Solutions, able to put that together and help those in need. And so we certainly appreciate it, and look for more information that as we go on throughout the year, and continuing to help those in our community that have a need. And then we do want to mention that many of you may have seen this, but you're going to be getting communications if you're a client that we now can help from a tax perspective. So, all of us on the call, we do a lot of tax planning for folks. And we really had a lot of clients over the years say, we really would be really nice if you could help us with our taxes and get our taxes done, and then have an integrated approach in you working with a tax accountant. So we now have that. So we have Hilltop Tax Solutions, and we have an experienced tax accountant that is leading that division. And you, as a client, we're offering an early bird special or a discount of 20%. And so you'll be seeing some communication. If you have a question and you're a client, you can call the office. You can talk to the client relationship manager, either Ashley or Tawny, or you can talk to one of us. And tax season is upon us, and we're prepared for that. As well as if you have a small business and you have accounting and bookkeeping needs, we can also provide those, and we're providing a discount for those services. So we look forward to that and helping you integrate, because taxes won't get easier. They're just going to get more difficult. And with the tax changes, you're going to want to make sure you have a good tax plan moving forward. So I think with that, I'm going to sign off. And so Bill, Cliff, Beth, and Matt, albeit virtual, we try to make this, we like to be around the table and talk about this around our table, conference table, but this is the next best thing. So we want to thank all of you for being clients. Forward to 2021, getting this pandemic been helping you along your financial, for the entire Hilltop team. And until next time, stay wealthy, Michiana.